Bismillahirrahmanirrahim. So today we are going to cover chapter 16 of the textbook. Which is about an open economy, that is one which has a foreign exchange sector. So basically we will be studying the balance of payments, the nominal exchange rate, the real exchange rate, aggregate demand, trades in goods and services, and currency crisis. So what is the balance of payments, and understand what is the nominal and the real exchange rate, and how does trade play a role in our national income, and understand something about currency crisis. Alright, so exports and imports. When we import something, it's a real good, and if we export something, then we send real goods abroad. So exports in a sense are bad for us, in the sense that we use resources and we produce things which are the final good is benefits others, while we work for its production, and imports are beneficial to us in the sense that other people worked for it and produced it, and we get to consume it. But of course there is a price that has to be paid for imports, and similarly we earn some revenue from exports, so this has to be balanced against it. But in the immediate standard of living sense, more imports are good in the sense of they increase the immediate standard of living, and more exports are bad in the sense that they reduce the immediate standard of living. Of course, earning money might have long-run implications of a different type. So basically there is only one reason to export, which is that we can earn foreign exchange, and this foreign exchange will allow us to purchase foreign goods. Right, so the balance of payments is the record of all our transactions with foreigners. One of these entries is the international investment position. So if I have foreign assets like foreign stocks, or these are my claims on outsiders, and then foreigners can also be holding Pakistani stocks and Pakistani bonds, and those are the claims, financial claims of others. So this has to be added and subtracted to get the net position. The balance of payment statement is a statistical statement that summarizes the transactions, goods and services, primary account, secondary, capital, and financial, and all others. You will see these things later. This is the balance of payments for Australia, which is in the textbook. So this gives the current account, goods and services, then there's so this seems to be net figures, that is 21,000 plus means 28,000 goods means that we imported, the imports minus the exports would be 28,000. On services there was a negative, that is the Australians provided more services to outsiders and imported less. Net figure was 21,000. Primary income means that if an Australian earns money from an outside source, like he's consultant to the government of Pakistan, then that is counted as primary income for Australia, This is the pluses, and for minuses, if Australia pays money to outsiders, that is counted as a negative, and so the net primary income is minus 54,000, which means that Australia paid a lot of money to foreigners for their services. Secondary income is basically income on financial assets. So if somebody holds Australian government bonds and they pay some money to him, that is a secondary income for the outsiders. And similarly, if Australians hold bonds of US and earn money for it, that would be count as plus on secondary income for Australia. The capital account, so this is the current account, which means basically goods and services. Capital account is financial part of this. So financial assets. So income is actually, secondary income is income earned from assets, but capital account has, if you buy a bond, that will come into your capital account. If you sell, if Australian government sells a treasury bill to some foreign bank, that will be a transaction which is recorded in the capital account. Similarly, there is capital transfers, which includes remittances coming in or remittances being sent out. Both of these are counted. And there is the financial account, which has to do with direct investment. You foreigners build a factory in your country. Portfolio investment, for foreigners buy stocks, financial derivatives, and other investments. Okay, so this is the definitions which I've just basically copied from the book. So this is goods and services, exports and imports. Apparently, if tourists buy goods, that's counted as a service because we are providing tourism service. Primary income. So primary income also includes ownership of financial assets. I thought that was secondary. So dividends and interest comes into your primary income. Secondary income is related to current transfers between residents and non-residents. This is just redistribution, and that is secondary income, and therefore includes remittances, charitable contributions, social benefits, and current taxes. So the current account is of goods and services, and that goes into aggregate demand. If we export something, that represents an aggregate demand from the outside for our goods, so it adds to the aggregate demand for domestic goods. Imports is money that domestic people spend on outside goods. So this is income which could have been part of the aggregate demand, but actually is diverted. So exports are injections into the aggregate demand and imports are drains. The capital account is the financial side, non-produced, non-financial assets, any lands and royalties, and capital transfers like remittances. So this is the balance of payments from Pakistan. So this is 4 quarters in the year 17, which goes from June 17 to June 18, and it shows that the current account balance is in the first quarter was minus 3.2 billion, and of minus 4.6 billion, minus 3.7 billion dollars, and minus 4.6 billion. And you add up all the 4 quarters to get the middle column, which is CY17, which is minus 16 billion dollars. So this was our current accounts balance was negative 16 billion. Exports of goods were 23,203. FOB means free on board. So there are 2 prices. There's free on board, I think, means that you put the good on the ship, and that's the cost. And then there is another initials which I forget, which is the
freights are paid by the ultimate importer.
I see.
Yes.
I see.
So
there's one price which, and if we are exporting to Los Angeles, there's one price of the good at the port of Karachi, and there's one price at the when the good is free and clear in Los Angeles. So these are 2 different prices which are used.
CIF is another
CI.
is the cost, insurance, and freight.
Yeah, CIF. That's the second price, which means that that's what the foreigner pays, and FOB is what we get. So this is there is a difference because of the freight and the insurance, etc. So FOB cost is FOB exports is 6152, which is about 23 billion dollars. Imports were 53 billion dollars. So there was a balance of payment deficit of 30 billion. Then we look at exports of services. That's 5 billion. Imports is 10 billion. There's another 4 billion deficit there. So total balance on trades in goods and services is about minus 35 billion. Then we get the primary income credit and primary income debit. So primary income credit is 659. This is what Pakistani nationals earned by working for foreign companies while staying here. And then primary income debit is what we paid to foreigners for their services. And so that is another negative 5 billion. Balance on goods, services, and primary income is around minus 40 billion. Secondary income credit is about 24 billion. Now we are getting positives here. General government means that the government received $604 million from outside, which has international cooperation of 136 and other official current transfers of $468 million. And then there's worker remittances, which is about $20 billion. And there's other current transfers of about 3.8 billion, which I don't know what it means, and I don't know where it's coming from. Secondary income debit, that is the amount that we paid as secondary income to outsiders. That was not a big deal. So balance on secondary income was plus 23,000. Current account balance is trivial. Both credit is very small and debit is none. So there was a 40 billion net deficit, and then about 20 billion of remittances, and about 4 billion of other earnings from various sources. Mostly it's foreign aid and coalition support funds, which is basically money that was being paid for the Afghan war. So 40 billion and then minus 25 billion plus, and that leaves us a net negative about 16 billion. That's our balance of payments. This is the financial account, which has direct investment, abroad from by us, direct investment in Pakistan, portfolio investments, financial derivatives, liabilities, etc. We don't need to go into these details. Alright, so basic concepts for trade. There is the nominal exchange rate, which we will discuss, which is basically, of course, everybody knows that the nominal exchange rate is dollar to rupee is, what is it these days, 130, 140? 140, yes. 140 rupees to $1 is the nominal exchange rate for dollars, and of course we can have nominal exchange rates against any other currency. In the past, rupee has been closely pegged to the dollar, so the dollar exchange rate would determine all the others. In the free floating exchange, all the rates can fluctuate independently of each other, so the dollar exchange rate would not determine the rate of the other currencies. But when you have a pegged currency, then your rate to the dollar is the one that matters, and then all other conversions are done by looking at dollar exchange rate with the other currency. So there are two types of exchange rate determination mechanism. One is the fixed exchange rate, which basically is the pegged exchange. Pakistan, if pegs its currency to the dollar, then that's exchange rate is fixed. And then there's the flexible exchange rate, where the rate is adjusted according to market conditions. And we will look at real and effective exchange rates, labor costs, and competitiveness. Alright, so effects of depreciation, like what happened recently. If rupees go from 105 to 140, what will happen? Foreign goods become more expensive, and in other things equal, this should lead to a fall in the quantity of imports, and the prices of our goods become cheaper, so this should lead to a rise in the quantity of the export demanded. That's the basic trend, but there are many things which might go wrong here. We'll discuss those later, but generally speaking, these are the expected effects, and this has indeed happened. The quantities of imports have reduced and exports have increased after the depreciation. If our domestic currency appreciates, then the foreign goods become cheaper, and so our imports will increase, and if our exports will become more expensive, so our exports should become less. So how is this exchange rate determined? Well, according to the basic theory, this is according to the supply and demand for our currency. Now the supply of our currency depends on central bank operations, and the demand for our currency is kind of a derived demand. It means that people don't actually want rupees, but they want to use rupees to buy goods in the domestic market. So if you have a strong economy, then the demand for rupees will be high, and if we have a weak economy, then the demand for rupees will be less, and that's why so in addition to spot demands, that is instant purchases, there is also a forward demand for planned purchases of rupees in the future. If you want to buy some things later, or if you have a sequence of purchases, then there is the issue of you can suppose that you will need to buy a large amount of Pakistani goods 6 months from now. So now, if you are a foreigner, you have dollars, then you can say, all right, so there will be a price 6 months later in rupees, and then I will convert dollars to rupees, and who knows what the price will be. So at this point I don't know what the price is. So there are a number of ways that this can be fixed. Either you can pay dollars now and say, okay, this is the price, and whatever the price is at that time, or you can sometimes say, okay, fix the price in rupees and 6 months from now, and then you can buy rupees in the forward market. So this is a promise to sell rupees at a certain exchange rate. So then when you buy the forward in the forward market, then your exchange rate becomes known. Quite often what you buy is an option to buy. So if the exchange rate becomes more favorable, then you can choose not to exercise that option and buy in the market and lose money on the option. So options are cheaper than full currencies, and they give you the option to buy at that price. So these are the real demands, but actually what happens in the market is that the biggest source of demand for currencies is speculative demand. Something like, the real trade amount is about per day is something like $10 million, and the actual trade is like 20 million, is 200 million. So about 20 times the amount of currency that is actually being used for trade is being swapped in financial markets. So there's basically a huge amount of gambling in currencies which is going on. You have almost moment-to-moment fluctuations in currencies. Today, if the price is 135 and tomorrow it's 136, that's a huge fluctuation, in the sense that 0.5% in one day adds up to a huge amount in the annual rate. So actually people gamble on these things. I had a friend in Yusuf Ziyairbech in Bilkent who started playing the markets. And so how do you play the market? Well, basically you look at the economy and you say, all right, I think that the dollar is going to go up tomorrow, or maybe it's going to go down tomorrow. So today, suppose that today it's 125, and I think it's rupees for the dollar, and I think it's going to be 130. Then I can buy $1,000 in and pay 125,000 rupees for it, and then tomorrow I can sell it back for 130 and make 5,000 rupees. Now, the way that this transaction is done is very interesting, because what you do is you do it on the margin. So here, as I've described it, I will put in Sawa lakh rupiah, 125,000, and then I will make 5,000. That's still pretty a good deal, but I can do even better. It's a good deal because you're earning about how much is it? 5. You're earning about 4% per day, which adds up to like thousands of rupees. Of course, you don't have that large fluctuation in a day usually, and even when you do, you can't forecast it. So, but the thing is, you can do much better by doing something like what is called buying on the margin. You give the stockbroker 12,500 rupees, which is 10% of the 125,000 you need, and you say, okay, I use this to purchase $1,000. Now, so the $1,000 is basically lent to you, and it serves as its own collateral. So you have purchased it, but you are going to provide the full amount later, and if you fail to provide the full amount, they have 12,500 of your cash and also the $1,000 that they have provided you. So they don't really have any risk in making this transaction. So this is called buying on the margin. I have paid only 10% of the price and I bought $1,000. Now if the price goes up to 130 as planned, then I will get 5,000, and now I have earned like a 33% return in one day, which is a huge amount of money. So that's how this gambling is done. The other option is that suppose that the currency goes down, then what happens? So if I was hoping that it would go from 125 to 130, but suppose it goes to 120. Now I have lost 5,000 rupees, and the broker will deduct 5,000 rupees from my 12,500. He will give me 7,500 back. If suppose that I say, okay, clear the transaction, and he will send the $1,000 back to. So that's it. If the dollar goes down further, like it goes down to 115 or so, then my whole 12,000 can get wiped out. And at that point you get what is called a call from the broker that I have your $1,000, you want to sell out and clear out, or do you want to put in more money to hold this position? So you think that it's going to go back up, then you might want to hold it, otherwise you might just want to get out of the market. So what happened to Yusuf Zia was that he was making a good amount of money for a while, and then one day I learned that he had sold his car. So normally you have supply and demand which determines the price, but actually in most countries the banks intervene in the foreign exchange market to keep the price of foreign exchange stable. Now, one of the main contentions of MMT, modern monetary theory, is that this should not be done. We should just let the rupee float, whatever the price is. The counter argument is that there is a lot of speculation. This would be a good thing to do if there was no gambling, and if the price was being set by the market, which basically looks at the demand and supply of the real goods, then the fluctuations would not be that high. But because people are gambling continuously, so there are very high fluctuations, and that makes trade basically difficult, because to do foreign trade you need to have some stable idea of what the price is today and what the price will be tomorrow. And the exchange rate risk makes it much more risky to do foreign trade than it is to do trade within your own economy, because here you know the costs and the prices and you can calculate your profits roughly, but in foreign trade you might end up losing a lot of money because suddenly and unexpectedly the exchange rate changes in certain ways. So because the central bank intervenes and tries to keep the currency exchange rate smooth, so the rupee can be overvalued or undervalued. If the market equilibrium is 150 and the rupee is selling at 130, then the rupee is currently overvalued, because the equilibrium price of the rupee is for the dollar is less than it's selling for. So if the central bank tries to stabilize at 130, then it will have to pump dollars into the market because the rupee is overvalued. If the equilibrium is 100 and the bank is holding the price at 130, then now the rupee is undervalued and people will want to buy rupees and sell dollars. So technically, when the currency is undervalued, then the central bank will be accumulating dollars and will be selling rupees. One key point that the MMTers make is that if the central bank does not intervene, then it doesn't need any foreign exchange reserves. This is our major concern over the past few months has been that we are running out of reserves, and if you don't intervene in the foreign exchange market, then central bank reserves don't matter. But if you want to make sure that your the exchange rate is a certain value and doesn't fluctuate too much, then you will have to use reserves to maintain the currency, especially if it is overvalued. Then you will have to pump dollars into the market and then you will lose reserves, and that's what has been happening. The counter argument is that if you allow the rupee to float, if it goes to 200 for example, then imports will become very expensive. So the counter argument is let them become expensive, but then we have some essential imports like oils and stuff, and so even there the counter argument is that let them become expensive, then we will develop domestic energy sources because they will but it will also have a damaging impact on production. So there are all of these complicated factors, long run and short run. So what happens when the exchange rate changes? We have discussed this. If the price of if the rupee appreciates, then imports will increase. If the rupee depreciates, then imports will increase. Imports will decrease, exports will increase. But what happens to the revenue is not clear, because suppose that the price of exports goes down and the volume of export goes up, then will the net amount of exports, the value, the amount of money that you receive go up or down? It's not immediately clear. If you're all economics students, then you have studied the condition of the elasticity, and you know that if the good is inelastic, then the demand, when the price goes up, the demand does not decrease in the same proportion. So because it's inelastic, so the good remains, the amount remains fixed, the price goes up, so the revenue that you earned from this good will go up. And similarly, if the good is elastic, then if the demand is elastic, then when the price goes up, the amount that is sold will go down by a lot, and so the total revenue will reduce. So the Marshall-Lerner condition is a condition which says that the sum of the two elasticities for imports and imports should be, price elasticity of demand should be greater than 1, and if that is so, then the normal thing that you expect to see happen will happen. That is, if our currency becomes if the rupee is depreciated, then exports will increase, imports will decrease, and the total balance of payments will improve. And the other direction also, if our rupee appreciates, then imports will increase, exports will decrease, and the balance of payments will become worse. This depends on the Marshall-Lerner condition. If it's not true, then even though when we depreciate the currency, our exports, the quantity of exports will increase, but the revenue that we earn will go down, and the effect on the balance of payment will be adverse. And many people have argued that this is the case for Pakistan, that depreciations do not help in improving the balance of payments. But this is not really true. Alright, so what are the effects of depreciation? The textbook looks at this and says that let's assume that things are normal, Marshall-Lerner condition holds, then a depreciation will improve the balance of trade. There are two types of conditions that can exist in the balance of payments. Either we can be in surplus, or we can be in deficit, or we can be in equilibrium, the third condition, of course. So if we are in trade deficit, then what happens, the foreigners increase their holdings of domestic currency, or SBP will increase the loans that it takes in foreign exchange because it runs a deficit which it has to finance. There will be a decrease in domestic reserves of FX. See, foreigners, if it's a currency like dollars, people might be content to hold dollars, and then there would be nothing that would happen. But if the foreigners acquire excess rupees as a result of our trade deficit, and they don't want to hold rupees, then they will try to cash these rupees, and this has to be met. Either this will cause a decline in the exchange rate, because when everybody is selling rupees, the price of rupees will decline, or if the bank supports the rupee, then they will lose reserves, and there will be a decrease in domestic reserves. And similarly, the opposite considerations hold when you have a trade surplus. When you have a trade surplus, then domestic holdings of foreign currencies will increase, and if you hold them, then your domestic reserves of foreign exchange will increase. If you sell them to get foreign goods, then that will have an effect on the exchange rate. So the nominal exchange rate is just a name, that is, we name our rupee, and we consider that, okay, there are 135 rupees. But like in Turkey, when there was a lot of inflation, they renamed the units. So from Turkish lira to Yeni lira, new lira. So if suppose that we were to introduce a new rupee for New Pakistan, so Naya Pakistan rupee is worth 1,000 of old rupees. Then now the nominal exchange rate will be 0.135. Yes, we will be able to buy in 13.5 cents for. Sorry, the other way around. $1 will be worth 0.135 of the new rupee. So suddenly our exchange rate has improved. Of course, nothing has changed. So this is the nominal exchange rate. It depends on the units of measurement. Change the units of measurement. So it doesn't measure any real economic thing. And this is one major mistake that the public makes, that they confuse the nominal exchange rate with the real. So how do we get the real exchange rate? Well, you look at a bundle of goods and you ask how much does this bundle cost in dollars when it is produced in the USA, and you take the same bundle and you produce it in Pakistan, and then you price it in Pakistani rupees, and then you convert, and then you compare, and that gives you the real exchange rate, which is measured as the cost of a certain number of goods in Pakistan and the cost of the same bundle of goods in USA. So if there is a rise in real exchange rate, then this means that goods are more expensive to produce in the USA and less expensive, and so this is called also a measure of competitiveness. Our competitiveness improves if the real exchange rate rises, and our competitiveness decreases because what it costs to produce our goods here is higher. This real exchange rate is what determines what happens to the exports and imports, because it's based on the competitiveness. So here is a very simple real exchange rate. This is called the Big Mac index. It's the cost of a Big Mac in dollars in various countries. So Switzerland is right at the top with $6.54 for purchasing one Big Mac, and in Sweden it's 5.83, and in the US it's $5.50 to purchase a Big Mac. You can see that the cost of the producing the Big Mac in the other countries is much less, like in Thailand it's 3.59. So the real exchange rate would be that the basically it's the ratio of 5.51 to 3.59. This is the continuation. In this you get to Pakistan. Pakistan, the Big Mac is $3.09 or 309 rupees, for example. So now the real exchange rate would be measured as how did it go? So it was $5.50 in USA and $3.09. So it's the ratio of these two. So it's about 160, something like the 175. 1.75 is the ratio of the Big Mac price in USA to the Big Mac price in Pakistan. So that is a measure of the real exchange rate. So if you look at countries which are below us, these are countries which are more competitive when it comes to production of Big Mac, and countries which are above us are less competitive when it comes to the production of the Big Mac. So China is about the same as us. Saudi is less competitive than us. We would be able to sell Big Macs to the Saudians. Mexico is more competitive, and India is much more competitive when it comes to Big Mac production. So Big Mac is not a very broad index, it's just one good. But if we made the same for a lot of goods, and what some people do, in fact I think the standard measure is that you take all of the goods produced by Pakistan, that's the GNP, and then you take this same bundle and you price it in different countries to get your real exchange rate. That's one way. Another way is to look at the tradable goods. So we look at all of the goods that we are exporting and importing, and that's the goods that we price to get the measure of the exchange rate. So depending on the bundle of goods you choose, you can get different measures of the real effective exchange rate. So what do we learn by measuring the real exchange rate? We should improve competitiveness to increase our exports. That is, we should learn to produce goods more cheaply. So how can we produce more goods cheaply? Well, basically if we think of the price as being a markup over wages, that means that either we must reduce wages or we must reduce the profit margins in order to produce goods more cheaply, in order to reduce the real cost of production of goods, so that our goods become more competitive and we can export more. So basically this means that the rate of wage growth should be lower than the rate of growth of productivity to increase competitiveness. So the laborers are able to produce more, but we are paying them less. If this happens, this will also cause lower domestic aggregate demand, because less money is with our population, enabling them to buy our goods. This can also lead to reduced productivity. It causes loss of morale in workforce. So if you on the contrast, if you pay people well, this boosts their productivity and competitiveness. So this is again another kind of aggregation paradox, that what the lesson you see, and if we want to according to these theories, then if we want to improve exports, we have to cut costs and we have to pay our laborers less. But this leads to loss in productivity and causes damage to our exports actually. And actually, paradoxically, oppositely, if we pay more to our laborers, they will become more productive, and this will actually boost exports. So the formulas go opposite to the theory. We have already seen this in some other cases where we looked at the paradox of thrift, where if everybody wants to save money, this causes the aggregate income to decline. If everybody wants to spend money, aggregate income increases and savings increase, even though they are planning to save less. So if you plan to spend, if your marginal propensity to consume goes up, you're planning to save less. This will increase the income so much that the savings will actually go up via the multiplier effect. Alright, here's a picture of Pakistan's export performance. As you can see, the idea that is widely believed is that we have done a terrible job on exports. If you look at the world export, our performance has been more or less in sync with that. So it is not that we have done terribly in exports. It is true that some countries have done tremendously well. Bangladesh and India and China and Korea, they have done tremendously well. But we have not done either too badly. We have had a normal performance, neither too good nor too bad. We just followed the world trend. So what are the secrets of having an extraordinary performance? Well, it seems that, and this is, I haven't actually verified directly, but I have heard from people who are economists that basically both China and Korea and other countries have followed an undervalued exchange rate, and when you undervalue your exchange rate, that you will boost exports and you will cut imports, and that will cause accumulation of reserves. And that's indeed true that China has huge dollar reserves, and so basically undervaluation will lead to the accumulation of reserves. Overvaluation will lead to depletion of reserves. So undervaluation is a good strategy to boost exports, and if your currency is normally valued, then you will follow the general trend, which is what we have done. The author of this paper says that there are 4 phases. In the first phase, we had a fairly good export performance. That was from 1990 to 1996. From the second phase, 1996 to 2002, exports have been flat, and basically he says that that's because of the economic sanctions following atomic detonation. And then in the third phase, exports grew quite strongly. That was from 2002 to 2006. And then the last phase, the performance has not been too good, and that's partly due, the dip is due to the global financial crisis. Exactly. This is up to 2010. I'm copying this from a paper which is on SBP, State Bank of Pakistan website. Okay, so then the text goes into the simple models for exports and imports, and actually this is the model that I picked up from the SBP website. So the real exchange rate, no, that's not the real exchange, that's the real exports. This is the value of exports divided by the quantity of exports, which is done by taking nominal exports and dividing by the price, is a function of world real imports, WIR. So world real imports is basically the aggregate demand for imports from the rest of the world. This function is being estimated on disaggregated level with each export separated. So the world exports is a very big number. It does have, there is this problem of that the world imports will include Pakistan imports, but as long as that's very small, this doesn't matter. So that's the aggregate demand for Pakistani goods by no, not Pakistani, that's the aggregate demand in general of the rest of the world. And then there's UVIP, which is the price of export goods from Pakistan, and UVIW is the competitor's price. So it's looking at Pakistan price of exports versus world price of exports. So it's how competitive are our prices relative to the rest of the world for the good that is being exported. Then there's the exchange rate index for Pakistan versus the exchange rate index for the competitive countries. So if the other countries are following undervaluation pricing, this will come into this variable. So these are the three variables that are used in the export demand function. The paper provides data on how much we export, and basically this is 1% or 0.2%, very small amount of the world share. The average is around 0.2 or 0.2% is what our share is in exports, with the leather yarn manufacturers and textiles are the largest exports that we have. Leather, textile, and articles of apparel and clothing. So basically we only export textiles and nothing else. When you look at the global share, that is. Now these are the export demand equations which we've already discussed. So here beta 1, which is positive, this is the this is the impact of world aggregate demand. And so you can see that the textile is 1.4, which is the largest coefficient. So if the world grows, then they demand more textiles, in terms of our imports, and rice is 0.3, leather is 0.6, etc. Beta 2 is our the pricing. So this can be used to measure the price elasticity, and I think everything is in log, so these numbers are directly the elasticities. And rice is relatively inelastic, less than 1, and the textile is relatively elastic, and similarly beta 3 is the effect of the exchange rate valuation, and you can get some insights as to what would happen if we change the value of the rupee to these exports out of these equations. Of course, these are a bit obsolete in the sense that these were estimated in 2010, and there are some other questions that you could ask about whether these are valid equations or not, but I just wanted to give you an idea about the export equations. So aggregate demand and the world economy. If the world income rises, the demand for domestic exports will rise, and this will feed into the domestic aggregate demand. Remember that our exports represent foreigners' demand for domestic goods, so it's like our aggregate demand, and this will have the same multiplier effect. We have done these calculations last semester as an increase in domestic aggregate demand. Net exports will rise. Net export means our exports will rise. our imports will also rise, but by less than the exports. Trade surplus will result in the short run. Income will rise, but by less than the exports. And there is a technical analysis with mathematics in the textbook, which I will not go over right now. So the last part of this chapter is about the currency crises. So first we just review the basic ideas of MMT, that the currency that we have is a sovereign currency, which means that we have authority to print currency. One of the key implications is that the government can print and buy unused resources, and this is the real fiscal space. You see, if the government, basically the counter argument is that the government prints money and buys things, then it will be competing with the private sector, and this will cause inflation. So if there is a resource that is already in demand and the government goes in and prints money and tries to buy that, this will cause an inflation in the prices. But if there is something that is not being sold and you buy it, this will not cause inflation. And this is the key message of MMT, is that the most important unused resource is labor. So the government should go and provide jobs by printing money. Now what will happen if the government does that? Well, these people who get jobs, they will have this money and they will spend it. And that will, now it depends on what they produce. If these people produce nothing, then this is just like printing money and having the same fixed amount. But if they produce something, then there is more goods and there is more money, so this should balance out. So what happens when the government provides jobs? That depends on how much productive capacity is added to the economy. So what is produced by these people who you give jobs to, and then also what is the demand that is created by providing this additional income. But this will lead to a reconfiguration in the prices. And one important thing is that foods would be impacted and imports might be impacted. So will there be a deterioration in balance of payments as we provide these guarantees? These people demand more imports. If this is so, then we won't be able to handle that, because with fixed exchange rates, this will cause our exchange rate reserves to decline. So technically, if we spend much, then it can cause balance of payment crisis, but the text says that we don't have any empirical evidence that supports this view. The increase in demand for domestic demand will increase the demand for imports, and there are two types of imports usually demanded. There are direct consumer imports, but also indirect imported capital for expansion of the domestic industry, which might be caused by the increase in aggregate demand. So to trace all these effects, you need what is called the input-output table, which industry is linked to which industry, and that would allow you to say what will happen if you provide job guarantees and you start people who are unemployed and use them to produce goods. The long-run consequences of such a program will depend on many factors. If you have a well-targeted job guarantee program, so the people are actually producing, basically one of the things that they should be producing is foods, because that's one extra place where the demand will come in. And in particular, processed food is things which we import from. Food that we import, we should try to make sure that that is produced locally. So job guarantees should concentrate in the expansion of foods, and especially foods which are being imported. And Pakistan today imports a lot of food, unfortunately, even though we are an agricultural country. And that's partly because we don't utilize our own labor, and partly because of the overvalued rupee. If we do provide jobs, that will give increased skills to our labor, and that would attract FDI. If that happens, then the current account can move into deficit, meaning that we are importing more goods. But capital account moves into surplus because people are investing in Pakistan. So what the net effect will be is not clear. If this does lead to depreciation, we have more imports, that will not cause too much damage to the poor, it will cause more damage to the elites. If a nation is importing food, then depreciation can be harmful. This is a real what the message that is being given here is that governments say that we cannot provide job guarantees because we don't have money. So this is not the real resource constraint. The real resource constraint, think about a sovereign nation which doesn't have no currency and no trade. Now the only issue is how can we produce things. So we will try to use all the laborers to produce things that exist, and we will swap among them. This is how the controlled economies used to work. The communist economies, they were targets that you will produce this, you will produce this. And so that is the real resource constraint. For the government, which has sovereign currency, which prints its own currency, to say that I don't have the budget to do this, this is nonsense. But there can be a real resource constraint in the sense that if all our resources are employed in producing, and now the government prints more money, then this more money cannot be used to produce anything real, and so it will cause inflation. So the real resource constraint occurs when everything that we have is already in use for production. If that is not the case, then money can be used to put the unutilized resources into production, and that is how we should operate an economy. Now what he is saying is that when there's not enough food, then we do have a problem, because that's a real resource. But he says this is not a real resource constraint, in the sense that we have made artificial nation boundaries. If we were to do something that would make sure that everybody gets to eat, then this resource constraint would not exist. So as a policy recommendation, he says that World Bank and IMF were created to deal with the post-World War II problems. There were two problems. The economies had been destroyed and the gold backing had been removed. So the Bretton Woods Agreement, IMF, was meant to stabilize the currencies and make sure that there is a lending mechanism to take care of balance of payments crises. And the World Bank, which is the International Bank for Reconstruction and Development, was meant to provide loans to countries to allow them to rebuild after the war. Now both of these issues are no longer relevant. We no longer need the post-war reconstruction, and currency stabilization should not be done according to the principles that were done in Bretton Woods. Unfortunately, thinking at the international level and also at the national levels is based on these gold models, and therefore very often very wrong types of policies are being pursued. Today we need new types of institutions. Basically we should look at the currency problem can be just managed in many different ways. If you have read my article on the lopsided system, I've explained how the current system, which is based on Bretton Woods, is extremely favorable to dollars and unfavorable to other currencies. It gives dollars the possibility of printing arbitrary amounts of cash for and acquiring real resources. So we need to have a different type of mechanism for trade. There are many proposals which have been put forth which are symmetric, and one of these should be adopted. There's lots of politics involved, so one needs to think about what can be done under the current environment. So that's one part, but the other part is how to make sure that essential resources are available to all people. This also needs to be handled by a supranational institution, just like World Bank and IMF, but it's a different type of institution that's needed. So new thinking is needed along these lines. So what are the lessons from the three major currency crises that occurred in the 90s? There was a European exchange rate mechanism crisis, which happened after the Berlin Wall fell and Germany was reunified. There was a Mexican currency crisis, also occurred in 1992, and East Asian crisis, which occurred in 1997. So we will just study these three crises to see what we can learn about why currency crises happen. So first of all, there was the reunification of East and West Germany after the Berlin Wall fell. East Germany was way behind West Germany in terms of infrastructure, and Germany made the promise to bring the standard of living in East Germany up to the same as West Germany. For that, massive investment was required in infrastructure in East Germany, and this meant hugely expansionary fiscal policy, right? And fiscal policy would have, according to the standard theories, caused inflation. MMT says that that's not necessarily true. If you utilize unused resources, then inflation will not occur. But policy is made according to theory and not according to reality. So what the Bundesbank, the German central bank, did was that it raised interest rates so that the fiscal expansion rate does not cause inflation. Just like today we have high interest rates in Pakistan, to prevent inflation, which is likely to happen because of the fiscal expansion that's also taking place at the same time. So what happened when you have high interest rate? Basically, the German mark will appreciate, because now it becomes attractive to hold money in marks as opposed to other European currencies, because the marks are paying a high interest rate. The European exchange rate mechanism was basically there was something which was called the snake, which was a
snake in a tunnel. I think they allowed a lower limit and an upper limit, and the currency was allowed to fluctuate within that. Exactly.
So there are 5, 6, 7 currencies in Europe, and they all had specified exchange rate. This is the target exchange rate, and then there was a tunnel, and because this picture looked a little zigzag, so it was called a snake. And then there was a tunnel, which meant that there were some bounds within which you are supposed to keep the exchange rate. So that was called the European exchange rate mechanism. If any of the exchange rates hits the upper bound, then the central bank takes action to bring it back into the boundary, and within the tunnel the exchange rate can fluctuate. Now there was an agreement to keep the fiscal policies aligned with each other. This was an informal agreement. It was not a treaty as such. And when the German the agreement was to keep the interest rates aligned also. Now the Germany was putting in a huge fiscal stimulus, and so it increased the interest rates to dampen the inflation. The other countries did not have a huge fiscal surplus, so they did not want to raise interest rates, because raising interest rates chokes off investment and causes damage to aggregate demand, harms business, leads to many other problems. So there was a dilemma, and in particular the British pound. Basically what happened was gambling by big finance. George Soros created the quantum fund. He thought that now this system cannot last, because the other countries will not follow by raising the interest rate. This will cause the German rate bank mark to appreciate, and the exchange rate mechanism will collapse. They will not be able to maintain the tunnel. So they bet that the countries would abandon fixed exchange rates and would devalue substantially against the mark. So what Soros did was to start short sales of the British pound against the Deutschmark. So short sale is something when you sell something more cheaply. You say, okay, at a future date. So you can say that 1 month from now, I will sell you 1,000 pounds at a cheap price against the Deutschmark. Currently, suppose they are trading 1 for 1. It was, I think, 4 to 1 actually. So you give me Deutschmarks, and if you give me 4 Deutschmarks, I'll give you 1 pound today. But if you give me 4 Deutschmarks, I will give you 2 pounds 1 month from now. So that's a short sale. So when you start selling these, this causes a decline in the price of the pound, because basically somebody who has this instrument, he says that I have 1,000 pounds which I can use 1 month from now, and the 1,000 pounds 1 month from now is only worth how would it go? Cheap price, Deutschmark experience. So is only worth 2 Deutschmark. Today it's selling for 4, but 1 month from now it will be selling. Once I have this option in my hand, for me the price of the pound is only 2 Deutschmarks in a month. So once you start selling billions of pounds worth of this, which is what Soros did, then this puts immense amount of pressure on the bank in order to support the pound against the Deutschmark. The Central Bank of England sold 6 billion worth of pounds. Basically they lost reserves before giving up and letting the GBP be devalued. So they gambled against Soros, and the Bank of England lost the gamble, and they lost a huge amount of money in the process of trying to defend this gamble. So the lesson is that the speculators won because of the peg. The textbook, if there was no peg, there wouldn't have been a problem, and also because they refused to live up to the requirements of the peg. Basically they had to, if they want the peg, then they had to up the interest rate, which they didn't do. So they can have only one of the two. If you have the peg, then you can't, then you have to keep the interest rate, or you should just give up both. Alright, so that was the exchange rate mechanism crisis. The 1992 Mexican peso crisis starts with the background of the 1980 debt crisis. Mexican foreign-owned banks took debt in foreign exchange from Middle East, which was had a lot of surplus cash because they had sold oil and they had accumulated reserves in foreign currencies, and they were looking at what to do with it. So the Mexican banks took it at a higher interest rate than was available in the world market. Then in the late in 1979, Volcker came into the USA. USA was suffering from stagflation, and Volcker decided that he would fight inflation and not worry about the unemployment. So he pushed up the interest rate, which caused a recession in the USA, and and did succeed in bringing down the inflation. But when the USA hit a recession, then imports from the demand from Latin America was reduced, and so Mexican economy went into decline. Also, the exchange rate between the peso and the dollar became unfavorable, and peso was actually being they also had a fixed exchange rate agreement. That is, they had linked their peso to the dollar, and so basically in 1982 the Mexico went into crisis. they announced that we don't have enough foreign exchange to service the foreign debts. As a result, IMF designed a bailout package, but they insisted on free market reforms and austerity standard conditions, which led to huge unemployment and poverty. And they also asked for privatization and to cut government to cut its budget by reducing social welfare, causing massive amounts of misery for people. So the standard economic theory is very hard on people. All adjustment costs are borne by the poor people. So that was in the 1980s. So after stabilization programs, growth returned, mainly based on Mexican oil exports. Foreign free market reforms also made Mexico attractive to foreign investors, and especially attracted lots of U.S. investments. In particular, U.S. savings and loans invested in Mexico in 1991 to 1994 period. Mexico ran a fixed exchange rate regime between peso. This was to give again confidence to foreign investors, because if you have fixed exchange rate, then you have then the foreign investors can. But the reality was, as the textbook says, that all the risks of trade were taken by the government and instead of the foreign investor. And then when this risk appeared, then the cost had to be paid by the Mexican government. So the policy recommendation here is let the foreign investors bear the risk of investment in a foreign currency. If they invest less, that's fine, because if you take the risk for them, then you will have to pay the cost of the risk. And that's what happened. So at this point, the IMF program was designed to make sure that the government doesn't run a fiscal deficit, and there was a surplus. But in order to manage its budget, the government issued foreign debt instruments, and they were designated in foreign currencies. So this was the big mistake. That okay, you sell me you give me $1,000 as a loan, I will give you $1,200 next year. Now, as long as you take foreign loans, but your repayment should be in local currency, this will create exchange risk, and this will make it unattractive. But that will prevent currency crisis basically. So when the government started to acquire foreign loans, the government there were capital inflows, but basically the demand for dollars became high, and the demand for and this should have led to depreciation, which should have solved the problem, but the government was defending the peg, and so it started to lose reserves. Attacks become even sharper as basically speculators realize that a crisis is occurring. They take actions to make it even worse, because they are betting against they are betting that the government will eventually have to fold. Exactly, this is what happened in England, that the government will have to devalue, and so once it is devalue, you can make huge amounts of money. Government made a policy mistake. It issued more bonds denominated in US dollars. This allowed temporary cheap acquisition of FX, but at a huge long run risk. So at this point there was a crisis situation. There were lots of infighting. The government had different factions supporting different policies. Central bank had different opinions. Fixed parity was maintained, even though it became obvious that the government could no longer support the currency. We had similar kind of situation very early in the Imran Khan regime, where everybody was worried that can we keep the rupee at this, and the central bank was arguing that we should let it float or we should let it go down. The government wanted to maintain stable currencies and so on, and there was a fight between the government and the treasury about this matter. I think in the newspapers they quoted me as being in support of the state bank position. Yes, yes. I think that the rupee should have been devalued when it was. IMF continued to argue that the Mexican policy was sound. At a meeting in November 30, 1994, they said that Mexico is following a good policy and we should support them, but in a month the speculative outflow became too great and the Mexican government floated the peso. This is what happened to the peso. After the float, it suddenly went from 3.5 to 7. So the peg was sort of a status symbol for the Mexican government, which says that we have a solid currency, and so floating was sort of a setback. Mexico also liberalized credit and privatized banking, which exposed the nation to rapid capital inflow without an increase in the ability of its financial institutions to handle the risk involved in international finance. This is something which also happened in East Asia, we will see, because when basically IMF, one of the things that IMF does is it says that you should have free markets and you should privatize. So the banking system was privatized and they allowed foreign exchange to come in easily, cheaply, which meant that a lot of foreign exchange flew in. But once they floated, then there was an extreme response by the international markets. The investors simply started selling off pesos in huge numbers because of loss of confidence. So basically, at the time when this was happening, the government was trying to decide whether to maintain the peg or whether to float. They had two options. They could have hiked the interest rates to encourage investors to leave their funds in Mexico, but if they had done this, this would have plunged the economy into a major recession. They could have broadened the band around the peg, but that would have been only a temporary palliative, and that would not have been very the debt servicing would have become very, very large. This is also what's happening here, that when we devalue the rupee, the debt servicing becomes the burden of debt becomes very high. So some of the lessons from the peso crisis is that a floating exchange rate exposes an economy to imported inflation, and this is a disadvantage. There is also erratic exchange rate which destabilizes trade, but there is an advantage in domestic stabilization. You can pursue your monetary policy to stabilize the domestic output and employment, and this is a significant gain. If you peg your currency, you lose the control of monetary policy, and fiscal policy can then no longer be used because if it also interferes with the monetary policy. Second thing is that the government should never acquire foreign debt denoted in foreign currency, and it should not acquire foreign exchange risk. The third lesson, which is also very important, is that expectations and speculation play a huge role. A lot of this problem happened. The last crisis is East Asian miracle, which we will cover next time. But a lot of things happened due to speculation. Eventually, the peso stabilized when the people realized that the economy is fundamentally sound. Nothing has really changed. So, but the speculation caused a lot of damage. So, basically, managing expectations is a huge part of economic policy. Around in December, there was a major meeting of leaders in policy in Pakistan. They said, now in 1 month we will be in the clear because the loans have been promised and they have come in, and so we should probably announce this, that we are now out of the crisis. And this announcement was made more recently, but there was a big discussion about whether or not we should announce, because basically it's all expectations. If people thought that we are bluffing that, and you see, we said, look at the reserves. The reserves are declining, and they will continue to decline for another month before they pick up and before the support that has been promised comes in. So if we announce that the crisis has been managed and we are out of it, and this will have a stabilizing effect. But if the public says that, look, they are saying this, but the exchange, the reserves are declining, then this might have a negative impact, that they are trying to bolster public confidence when in fact situation is even worse. And so this was all public psychology, and so finally we decided not to make a strong claim about how problems have been solved, and because until there is a positive indicator in the reserves. So the point of all this is that managing reserves and managing expectations, because there is a huge amount of speculation that if people think that the rupee is going to go down, you can make a lot of money by especially when the capital account is free, when you can freely buy dollars and speculate against the rupee, then this actually makes the price of rupee subject to what people think the price of rupee will be, and that means that you have to manage expectations, and the central bank has to have authority and confidence with the people that it can stabilize things, and it has to have enough reserves to be able to do that. If the central bank has no reserves, then it cannot take any action, so it will be helpless in the hands of speculators. So all of these are issues that we learn by looking at the nature of currency crisis. And so next